So, welcome back to Everything Marketplaces, where we talk with founders and leaders from some of today's top marketplaces. So, this is episode 116, which is a really great group chat that we just had with Jeff Fluhr, who's a partner at Craft Ventures. So, Craft Ventures is an early stage venture fund that's backed marketplaces like ZocDoc, Airbnb, Eventbrite, Lyft, and more. So, prior to Craft, Jeff was also the co founder and CEO of StubHub, which is notably acquired by eBay. So some really incredible experience of both a marketplace operator and now investor side. So this is a really great chat with Jeff where we got to learn more about his experience taking StubHub from idea to acquisition by eBay, now at Craft Ventures investing in marketplaces, and also had a really great group Q&A. So I really enjoyed this conversation and you're going to find it a great watch to the end. So Jeff, welcome to the group chat. It's a real treat to have you join us here today. So I'd like to first off, start by saying a huge thanks for taking the time to do so in advance. So you have some really incredible experiences, both a marketplace founder, an operator with StubHub in the past, and now investing in them at Craft Ventures. So I'm really excited to dive into things here with you today. Before we do, though, I think it might be great if you can start off by sharing a little bit more on your background, though, for those that don't know you.
So yeah, my background, let's see, I guess, going back to college, I studied finance and engineering at the University of Pennsylvania. My first job was working in LBOs at the Blackstone Group in New York City. Spent a couple years there, and then I went to Stanford Business School, and I started StubHub in the middle of my first year at Stanford. So there's a business plan competition every year at Stanford Business School. So my co-founder and I submitted the StubHub kind of executive summary to that annual business plan competition. And then, ran StubHub as CEO from March of 2000 when we incorporated through the sale to eBay. We sold it to eBay in 2007. So it was about a 7-year run as CEO of StubHub. And then after that, I left actually the day the deal closed. So eBay did not want me to stick around, which was fine with me. And so from like February of 2000 or March of 2000 to 2007, when I left, I started doing a lot of angel invested for a few years. Then I started another company called Spreecast, which was in the live video space, which was sort of like a Facebook meets Skype at the time. And we could talk more about that company and what I did there, but that ultimately did not work out. And I continued to do angel investing during that time as well. That was like 2010 to 2016 or something like that. And then I teamed up with David Sachs at Craft in 2018, and I've been at Craft now for about 4 years. And Craft, we're a venture firm. We can talk more about what we do exactly, but we invest in SaaS businesses and marketplaces primarily, and we are looking for great marketplaces. So if anybody's working on a great marketplace, please send them my way.
Yeah, that's awesome. That's a really incredible background. So, thanks for sharing with us, and so much we can get into here. But I guess, kind of going back to StubHub, since that's a marketplace, we all know of, and many of us have also probably used. Can you walk us through, your experience there? Taking it from initial kind of idea in that pitch competition to the actual acquisition. Maybe just highlighting some of the kind of pivotal points along the way and challenges.
Yeah, sure. I mean, it's obviously, I could probably talk for an hour just about StubHub. So I'll try to kind of give the sort of relatively high level. I'll talk a little bit about the competition, a little bit about some of the challenges and decisions along the way, and then we can go deeper on anything, that you want to, Mike, or people want to talk about later. So yeah, I was a first year at Stanford GSB, and I would have been the class of 01. So my first year was like, September of 99 to May of 2000 or something like that. And, this was a time, so the late 90s was, I don't know how many of you on this call today were, kind of adults then, but it was a time of the first wave of the internet, right? The late 90s was when Internet 1.0 really came to life. And so you had companies like Amazon and Yahoo and eBay and Netscape that in kind of the 95 to 99 era were, going public, were getting to scale. And some of these companies in the public markets were then, kind of enjoying huge valuations, which, kind of is reminiscent a little bit of, the 2021 run up in pricing. In that there was sort of this crescendo in 1999 and the beginning of 2000, kind of like there was last year, actually. And that, so, and then there were a lot of companies also that were going public that had, the companies I just mentioned, were all, for the most part, fairly solid companies with real business models. There were also a bunch of companies that didn't have real business models, and really the kind of general consensus at the time was all that mattered was how many eyeballs you had. So it was like, how many eyeballs did you aggregate as an internet company, and it didn't matter if you had revenue or anything else as long as you had quote unquote eyeballs. So anyway, that because and I had been working at Blackstone in sort of that most of that run up, and Blackstone, we were investing in kind of old manufacturing type companies, right? So like Middle America, cash flow generating, low growth, but highly cash flow productive companies. And we were borrowing a bunch of money and then buying these companies mostly with borrowed money. And you could make a lot of money that way. And they were really smart people at Blackstone, and I was learning a lot. But I was much more attracted to what was happening, largely on the West Coast. I was in New York City, and I was kind of much more attracted to what was happening with these internet companies. And my background, as I mentioned, was I did have an engineering degree from Penn. And as a teenager, I had started experimenting with the internet with my modem. My dad worked for AT&T. He brought home like a PC computer when I was, I don't know, 10 or 12 years old, and along with a modem. And I was using my modem back in those kind of junior high school and high school years, to call up what were called BBSs, bulletin boards, which was sort of like the predecessor to the internet. And I was calling bulletin boards and downloading programs and stuff. So I had this interest, and I was learning to program back then as well, and did some programming in college. So I was interested in technology. I was interested in programming computers, but there I was at Blackstone, kind of with these boring manufacturing companies. So I really was attracted to what was happening on the West Coast with the internet. Went to Stanford Business School, and in my first year, wrote a business plan for StubHub. My co-founder and I kind of were sitting at lunch one day and started talking. He had a similar background to me, and we were talking about, gosh, we got to do something on this internet. This is so exciting. And so we submitted we kind of came up with the idea for StubHub, and wrote a business plan, an executive summary for the business plan for StubHub for the competition. We were selected as one of the 6 finalists. And I think there were like 54 submissions or something that year, and we were one of the 6 finalists. But we decided that we actually did not want to show up for that final round. So if we had shown up for the final round, and if we had won the competition, like the Stanford newspaper would have done a little profile about us and about our company, and we would have maybe attracted some more attention. And we decided at that point, I had already decided that I wanted to start the company. And so I felt like it would be an advantage to kind of stay under the radar and not actually attract more attention. So we didn't show up for that final day of the competition. So only 5 companies showed up. I incorporated the company in March of 2000, which was exactly the 1 month before April of 2000, when the entire internet economy kind of collapsed, right? So in the same way that we've had a huge reset in valuations kind of between, call it, November of last year and May of this year, mostly in tech stocks and now more broadly. We had that same kind of huge collapse in internet stock prices in April. It started in April of 2000. It kind of lasted for the better part of a year or two of kind of downward price pressure on the internet companies that had gone public, and companies that were private suddenly found it very challenging to raise capital. Many of the companies, including companies that had gone public, ended up going out of business because they were burning cash and they had no ability to raise more capital, even in the public markets. So it was kind of a good, 24 months of real pain in anything related to the internet. And so this was the environment that I was operating in as a 24-year-old founder. And access to capital was basically, non-existent. So, and we could talk more about that. I think some of the lessons from that, I think are really important and relevant today. And we should circle back on that. But anyway, so we started StubHub in March of 2000. I finished my first year through whatever it was, May or June of 2000, and I did fine, but I didn't go back for my second year of business school. So I dropped out of Stanford after my first year, and and ran the company as CEO. And so some of the things, I mean, I would say that the probably the key things along the way of the StubHub path that were that were probably interesting and relevant for the broader community here are as follows. Number one, like with all marketplaces, we knew that we had to sort of isolate a smaller problem and sort of solve a smaller problem before trying to solve everything and boil the ocean day one. So the way that we did it at StubHub, and I think it's a common strategy, there were a couple things that we did. And I think these are both strategies that may be relevant for other marketplace founders here. One is we isolated the problem just to the Bay Area. So rather than trying to build a marketplace for tickets where people could buy and sell tickets for any event across the country, we just focused on the Bay Area. As I mentioned, I was at Stanford GSB, so I was in the Bay Area, and I thought that doing it, close to home would be easier than doing it, on the other side of the country. And so we identified, the Bay Area as our sort of launch market, and we didn't try to build a business, in New York or Miami or Chicago. We only tried to build a business in the Bay Area, and that by doing that, we had like a petri dish where we could try to generate some initial liquidity and get the flywheel spinning in a much smaller test environment and kind of grow it from there, rather than trying to do everything out of the gate. So that was one key decision we made very early on that I think was really helpful. Another thing we did early on that was helpful was we tried to, we knew that the classic problem with, I think, all marketplaces is like the chicken and egg problem. How do you get your marketplace has zero value to the demand side if you have no supply, and your marketplace doesn't have any value to the supply side if you have no demand. So how do you kind of get that initial kind of kindling to get a little bit of a flame and a spark going? And so what we did, and this is, maybe relevant for some markets, but maybe not relevant for all markets, but we were able to do is we worked with some local ticket brokers in the Bay Area. The way the ticket brokerage industry worked back then, and probably still to some extent today, is that there are these kind of regional brokers who are kind of mom and pop businesses where their business is, they buy tickets, they get access to tickets, and they have different ways of getting access to tickets, but they get access to tickets and they pay, X dollars for their tickets, and then they sell them for 2X, and that's their business model. And so those businesses tend to be regionally focused, and they don't have kind of national coverage, but they focus on the Bay Area or New York or whatever, and they're kind of mom and pop businesses. So we were able to recruit some ticket brokers to list their tickets on StubHub, on the very early first version of StubHub that we built, which allowed us to kind of short circuit one side of the marketplace, because all we needed was, a small number of those ticket brokers, even literally 5, 4 or 5 or 6 ticket brokers was enough. Because this was their business, they had enough coverage of events just with those 4 or 5 sellers that we could then just focus. But after kind of locking them down in getting them to agree to list their tickets, we could really just focus on the demand side and driving demand to the tickets on StubHub, and therefore kind of getting the beginning of the flywheel spinning. And we knew if we had demand and they were if these sellers were successful selling tickets, that they would stick, they would come back, and they would sell more tickets, because that's all they really cared about, was selling tickets at the highest price possible. So that was a way for us to kind of short circuit one side of the market. So then we further isolated the problem, not only to the Bay Area, but really just to the demand side. and that tends to be the hardest part of the problem in most marketplaces, is getting demand, to come and pay for something, right? To buy something. So that was kind of what we did in the very early days. And we launched the first version of StubHub in like October of 2000. And we slowly built from there. I mean, first we had just the Bay Area for, I don't know, 3 to 6 months. And then we launched another city, probably, also west of the Mississippi. I don't remember the exact sequence, but I know we were like in Phoenix at one point, and probably, Seattle, I think, were 2 of our next cities. And then we kind of, at one point, maybe approximately a year after launch, we said, okay, we're going to just like open the floodgates. And we just sort of added all of the event information for events across the country, and kind of were quickly able to kind of parlay that into a national marketplace. And so that was one of the early learnings. I would say the other big, a couple other big sort of like moments in the StubHub story. One was kind of what I would call like the go-to-market strategy. Initially, so when we first started StubHub, the name of the company was actually Liquid Seats. We had this kind of dual brand strategy early on. We had the company name, which was Liquid Seats, and we did also have the StubHub name, which was kind of which was the destination kind of consumer website where you could buy and sell tickets, kind of what StubHub is today. But the reason we had the Liquid Seats brand, and that was our company name, was because we felt that it would be a lot easier for our go-to-market strategy to be kind of a B2B strategy, to partner with sports teams and the leagues, and also with media companies like at the time it was properties like Yahoo or MSN that had tons of traffic, and big brands. And if we could partner with them and kind of build like a co-branded ticket marketplace, it might even be called, the Yahoo ticket marketplace or something, powered by Liquid Seats or powered by StubHub, depending on, we were confused essentially about our brand, but the idea was that we were going to be more of a B2B company than a B2C company. We weren't really focused on building a consumer brand in those early days. We were more focused on trying to partner with these other distribution partners that had a lot of traffic to bring both demand and supply, primarily demand, but demand and supply to the marketplace. And so that was what we did for the first couple of years. In most cases, we co-branded these marketplaces. It would look and feel like you were still on like the MSN website, which was Microsoft's version of Yahoo at the time. I don't even know if it still exists. I don't think it does. But it was actually hosted by our server, so you had all the navigational elements that would be on the pages, and that worked in a way. I mean, we were getting some of these deals, we were driving some volume, we were growing, but our growth was kind of linear in the sense that like it felt constrained. Like we had to do these big partnerships to get the next kind of sort of step function of growth, and those partnerships were out of our control. We had a couple of us working on the partnerships, but we couldn't force a partner to work with us. We had to kind of get them to agree to work with us. And even when they did decide to work with us, there was a limit on how much of an incentive they really had to push it. It wasn't, the top priority at the most senior, most levels of MSN to kind of promote their ticket marketplace, even though they were sharing revenues with us and such. They had a lot of other things that were higher priority. So it was never kind of the biggest priority for them to send us traffic to those pages. And so it felt constrained. So what happened in those, one of the things that really caused an inflection point for us was the launch of Google AdWords, which, I mean, people today, it's like obvious, it's been around, and it's really what propelled Google to be worth however many trillions of dollars Google is worth today. But it's, in a way, I think StubHub, I guess, predated Google AdWords, because it didn't exist when we launched StubHub. And I think it maybe launched in like 01 or 02, shortly after we did. And we started experimenting with Google AdWords, right? So we started, like, what we realized pretty quickly is you could, like, I mean, this is obvious today, but like you could like pay for the word, Yankees tickets in Google, and every time somebody typed in Yankees tickets, we could have like our ad pop up right there. We could drive those people directly to this StubHub branded marketplace, and we would generate transaction revenue, and we didn't have to share it with anybody, because all of those co-branded partnership deals that I mentioned were all revenue share deals, and we were sharing our revenue with third parties. And so with this kind of paid search driven strategy, we were able to keep, we had to pay for the customer, whereas the other ones we didn't. But then we kept that customer forever, and we kept 100% of the revenues, not only on the first transaction, but on every transaction. So we quickly, and because it was early in those days of AdWords, it was a little bit of an arbitrage opportunity, right? There wasn't yet a competitive market. It wasn't as competitive as it is today to bid on these keywords. So we were pretty early to it. And anytime you have a new kind of system like that, if you're early to it, you kind of get sort of a first mover advantage, where it takes others a while to figure it out. And we had a good, couple of years there where it was, we had a really nice sort of economic flywheel where we could pay, call it $50 to get a user, and we would make $60 every time we got the user on their very first transaction. So obviously we just started, we realized that, we started pumping more money into that. And by 2003 or so, we were like, screw this liquid seats thing. Let's just focus on StubHub, on this consumer brand, because we're able to scale it much more quickly. We can control our own destiny. It's just like a machine where you put in a quarter and you get back $1. Let's just put in as many quarters as we can. And so we then, that was really what drove us to to focus on the consumer brand. And kind of, we still did partnerships with teams, primarily with teams and leagues, and to some extent we did some other media partnerships like ESPN we did later on. But they were very different, those partnerships. They were no longer revenue share agreements. We were just paying up front to a sports team a certain amount of dollars per year to be kind of an official sponsor, the same way that like Anheuser-Busch or Pepsi might sponsor a team and have a big sign in the outfield. And we also got mailers to season ticket holders and things like that. So we paid for these deals, and because we had an asymmetry of information, we knew what the deals were worth, and we were able to, pay $500,000 a year for a deal that we knew was going to drive, $1 million of gross profit or something like that per year. So we didn't have to share revenue. We didn't even have to share data with the teams about, how many tickets we sold or the names of the people that we sold the tickets to and stuff like that. So it gave us, the deals changed, even though we still did deals. And the strategy of the business changed from this kind of B2B driven strategy to more of a direct to consumer strategy. That was probably, the biggest sort of strategic change that happened at StubHub that I think really unlocked growth for us and helped us, really kind of get to the next level. So, and then, there were a lot of other kind of things along the way. I would say like the PR was sort of an interesting kind of challenge along the way, because we were trying to shine a light on what had historically been a very murky business, right? The ticket scalping business, where people think about, buying tickets from some guy in a trench coat, in an alley near the venue or something. We were trying to say like, hey, like, let's make this safe and transparent and legitimate. But at the same time, we had a lot of journalists who tried to kind of paint us in a light of just being like an online ticket scalper, right? And our view, and my view still today, is that there's nothing wrong with selling a ticket for like the fair market value of whatever. If you have a willing buyer who's willing to pay you $1,000 for a ticket, and the seller would rather have the $1,000 than their ticket, and the buyer would rather have the ticket than their $1,000. Regardless of the face value of the ticket, whether it's $20 or $100 or whatever, like the government shouldn't stop you from like doing a transaction between a willing buyer and a willing seller. But the reality was at the time, and to some extent still today, there are and were some state laws that restricted the price at which you could sell tickets. And there was this kind of opinion among some people and some journalists that like there was something morally and ethically wrong about selling a ticket above the face value or for too much above the face value. And so there was this kind of PR challenge along the way that, on the one hand, we were trying to say we were the solution to some of these problems, but on the other hand, we had certain journalists that tried to just say, no, you're just like an online ticket scalper. And so there were, that was both a PR challenge as well as a legal challenge to some extent, because as I mentioned, there were some state laws. And so that became, sort of an interesting challenge, as StubHub got to some more scale over time. And then ultimately, we sold it in 2007, to eBay, and that was kind of, as I mentioned, I left the day the deal closed. So anyway, that I could talk for a lot longer about it, but I don't want to bore everybody to death. So I'm happy to go into deeper on anything else. But that was kind of those are some of the key things and key steps along the way.
No, there's so many great insights and learning. So thanks for sharing with us on this. Yeah, you definitely touched on some points that, I wanted to bring up, which is kind of, constraints kind of early on. And then I would say, go-to-market strategy and kind of unlocking growth. So I'm glad we got to jump into that. And I'm sure we'll have some questions here during the Q&A on that to expand more. I guess to learn a little bit more about the acquisition though, like what led to that? And I would say from a personal kind of founder journey, how did you kind of think through that?
Yeah. So we had a couple of different overtures at different times from bigger companies that were interested in what we were doing and sort of approached us with the message that they were potentially interested in buying us. One was Ticketmaster pretty early on. And Ticketmaster was kind of, we called them Darth Vader, because they were kind of this notoriously sort of difficult company to deal with, kind of anti-competitive in a lot of ways, did a lot of things to try to get the teams to not work with us, threatened the teams, threatened us, tried to use some of the PR kind of messaging I was referring to, and some of the state scalping laws, and kind of against us, even though they were more or less involved in ticket scalping as well, or kind of reselling tickets. So we did have a conversation with Ticketmaster early on, but it didn't go very far. And in retrospect, I don't think we should have done that. eBay had approached us a couple times, and we had a pretty good relationship with eBay. eBay, they were not, kind of an evil empire the way that Ticketmaster was. They were a much friendlier company. I still think they have that, reputation, generally speaking, today. And we were collaborative with them as it relates to government relations. So we had been working with them in a few states. The way the ticket scalping laws work is there's no federal laws. So as far as the US government's concerned, you can sell a ticket for $1 billion if you want. But there were some states, many states also had a free market, but a handful of important states had ticket scalping laws, and it was statewide laws. So we were working with eBay as we got to some more scale to try to modify, to try to lobby and get certain states to change their laws. And so we had sort of a collaborative relationship with them, primarily on the sort of scalping law on that effort. But we also kind of knew the guy that ran their tickets category, and we sort of, were friendly with him. And they had approached us, I think when we finally did the deal, I think it was the third time, maybe it was the second time, I don't remember, but they had approached us at least once before, and we never kind of got very far because the price discussion was never interesting. And then when they approached us the last time, when we finally sold it, which was kind of like the second half of 2006, I had been doing it for 6.5 years. My wife was pregnant with our first kid. I got married, kind of halfway into the StubHub experience. My wife was pregnant with our first kid. We had about 450 employees. I had got to the point where, the job was kind of in some ways less interesting to me. It was, I enjoyed sort of the early startup stages of scrappy, 10 people in a room building stuff and, celebrating every little milestone. And, there were certain things about the job that I just didn't like as much, managing lots of people, dealing with, sort of HR issues or challenges. And and so I just kind of gotten to the point where I was I was also open to kind of moving on, and also I knew that, the work-life balance, it had gotten a little bit better at that point because I had a senior team that I could rely on. So it wasn't as crazy as the first couple of years where I was, working 80 hours a week or more, and, never really sort of not thinking about, the company, kind of always thinking about it no matter what I was doing. So that was a little better, but still not, great. And I kind of like the opportunity of, I felt to myself like, hey, if I sell the company, I can still start another company, right? And I can do it again. It turns out it's not that easy to do it again, and we could talk about that. As I mentioned, my second one did not work out, but I kind of told myself that, this isn't going to necessarily be my last chance to do it, and I thought I could kind of do it again, and I was kind of ready to move on. And they got to a point, on sort of terms and price that I thought was a reasonable price. In today, in the market, in the 2020 market and 2021 market, it wouldn't have been a reasonable price for a bunch of reasons that we could talk about. And in retrospect, I sold the company at a time, StubHub today is worth, well, eBay sold it recently for $4 billion. So it's worth 4 billion or more. But then I heard they what do you call it, filed to go public. It never happened because they filed to go public, I think at the beginning of 22, like earlier this year, and then the market cratered. So that didn't happen. But, I've heard that the price stock was like 13 billion or something like that. So, it's worth a lot more than what I sold it for. I sold it for 310 million, which at the time was one of the, I think it was like one of the largest deals that year. And it was kind of a pretty large deal. Today, it's like a Series B round. But, so in retrospect, I sold it early. It was a life-changing event for me, financially. I didn't grow up with a lot of money. I mean, I wasn't poor, but I didn't, like, my parents weren't wealthy. So, there was a lot of positives to it. And I think it was a good time for me. I ended up having all this time with my newborn son, who's now almost 16 years old, sophomore in high school. So, I think there was a lot of positives to that. And, I don't regret it. But it's a huge decision, and obviously, and when you have a company that actually is working, I mean, the one thing I will say, when you're running a company that's actually working and kind of everything you finally figured out, because it's so hard to get to that point, right? I mean, and as an investor and as an entrepreneur, a second time around that didn't work out, I know how hard it is to kind of get to escape velocity where you've got success and you're growing at a rapid pace. Like it isn't that easy to get that again. And so if you decide to sell, it's a huge decision, and you got to really think it through. And there are pros and cons to selling it. It turns out we sold it in 2007, and 2008 and 9 was the Great Recession. So it was we sold it in a market right before a kind of a 2-year downturn. So obviously it's much better to sell when the market's, kind of, positive and maybe even frothy than it is to sell in a downturn. So anyway, those are just some thoughts, but yeah.
Yeah, no, it's definitely sounds like such an incredible journey, and not many people can say that they've sold their company to eBay. So that's a really awesome, huge congrats on that. So definitely want to jump into a little bit more on the investing side now too. So could you maybe share a little bit more about what led you to joining Craft Ventures, and then maybe a overview of it as a venture fund?
Yeah, sure. Yeah, my shirt says Craft. So I've known David Sachs for a long time. When he was at PayPal in the early 2000s, and I was running StubHub, 2002 or 3 or something like that. I met him through a mutual friend, and kind of kept in touch with him over the years. And he actually invested in my second company, Spreecast, that I mentioned briefly. So we've kind of been friends and known each other for a long time, and he has a similar background, right? He's kind of an operator founder, who had done a lot of angel investing successfully, and then decided to launch Craft in 2017. When I decided to wrap up Spreecast, he reached out to me and said, "Hey, why don't you come join me at Craft?" And I spent some time with him and some of the other the early people that were at Craft at the time, and and decided it was a great fit for me. I had started my career as an investor, as I mentioned, at Blackstone, right? So like my very first job was investing. I had always been an active investor in the public stock market, even as a kind of teenager. I don't know when I opened my Schwab account, but maybe I was, 13 or 14 years old or something. Um, so I, learned how to, buy and sell stocks, and, had a finance degree from Wharton, worked as an investor at Blackstone. And then I was an entrepreneur for kind of 20 years, but I knew a lot about finance and investing. And I had done a lot of angel investing successfully. And I thought that, getting back into investing, specifically venture investing, was a great sort of next step for my career. I knew that I didn't want to start another company. I had at that point, in 2017, 2018, I had 3 kids. I now have 3 kids, ranging, now they're 10 to 16, but then they were whatever, call it, 5 to 11 or something. Um, and um, and so I knew that, I felt that like starting another company would be challenging with 3 kids, just the work-life balance questions, my own sort of nature, and I think is generally the case, is like I'm all when I'm when I'm starting a company, I'm so all in on it. It's like I have blinders on everything else in life, and so it's hard to do that and also like have a family and be a husband and be a dad. So I didn't want to start another company, and but I love technology, I love software, I love startups, I love entrepreneurship, and it was a great way for me to sort of stay involved in all of that stuff without kind of carrying the flag of being kind of a CEO founder myself, and be able to share a lot of my learnings and knowledge with lots of founders, who I work with today, instead of just kind of being so laser focused and tunnel vision on one thing. So so that's and I've always had a lot of respect for David. I've kind of known him for a while. As I mentioned, he's an extremely smart individual with a lot of super impressive experience and sort of track record in, like I said, both as an entrepreneur and as an investor. And every time I sat down with him, talk about my company or whatever, I was always kind of leaving those conversations with like a new insight or a new learning. And I just felt like working with him would be just great for me personally, and just another opportunity to learn more. So, um, so it was a pretty easy decision, actually. Once he reached out to me and I kind of spent some time talking to him about it, and you know, kind of joined in 2018. I've been there now for about a little over 4 years. And I focus. So a little bit about Craft. So Craft is, we are primarily an early stage venture firm. We have kind of 2 products, I guess you could say. One is our kind of flagship early stage fund. It is it invests that fund, and then and our second fund is a growth fund. We more recently have added growth into the mix. Our flagship early stage fund invests in kind of seed A and B rounds, primarily of SaaS and marketplace businesses. Actually, most of what we do is SaaS, primarily because we see a lot more SaaS businesses than marketplaces. One of the things, I think marketplaces are kind of hard to find, really interesting marketplaces. And so we don't see as many interesting marketplaces, but so probably 60+% of what we do is SaaS, and 30% marketplaces. But those are the 2 areas we focus on. David is an expert in SaaS, just given his experience from Yammer. I'm an expert in marketplaces, given my experience from StubHub, and also a lot of other investments I've made. So we do seed A and B rounds out of the venture fund. The one caveat I would say there, and we can talk more about this, but is we really only, even at the seed stage, we don't do like pre-revenue or pre-product companies. Like, we only invest in companies that at least have built a product and launched it, and generally speaking, have at least some users and growth in users that we can see. And generally they have revenue, even at the seed stage. So they have revenue. It's not enough to raise a Series A. So maybe it's not like $1 million of net revenue yet, but it might be 100,000 or a couple 100,000 kind of net revenue, and they're growing nicely. And that so the seed stage we do is not like, two people in a deck. It's a little bit further along. But we do seed A and B rounds out of that fund. Check sizes range from kind of a low of about $1 million up to a high of about 25 million in that fund. And then we have a growth fund now as well, which invests in the same types of companies, just a little bit later stage. Our growth fund is in a way, it's more like a late stage venture fund. We don't do like the $5 billion valuation about to go public company investments. We do more the call it 400 million to $1 billion valuation, pre-money valuation companies that might be Series B, C, D rounds. Again, SaaS and marketplace companies. Those check sizes range from like a low of like 10 million up to $60 million check sizes. We have about $3.3 billion of assets under management now. We have about 38 people on the team. Our investment team is about 18 people, 17, 18 people. And then we have a 12 or 13. The investment team is primarily focused on identifying new opportunities, making investment decisions, winning deals, and then adding value to those companies after we invest. The platform team, which is about 12 or 13 people, all they do is try to add value to companies after we invest. They don't really get involved in identifying new opportunities or making investment decisions. They're just there to help our companies succeed. Half of that team is recruiters, so they're helping our companies with recruiting. And then the other half are like subject matter experts in things like government relations or information security or online customer acquisition, things that many of our companies would, like help with or advice on. It's a pull model. So we don't like push this onto the companies, but if they want help, they can kind of ask for it. And that's the platform team. It's about 12 or 13 people. And then we have sort of some back office folks that are involved in just kind of LP relations, fundraising, capital calls, distributions, things like that. Yeah, that's the firm. It's been a fun ride. It's obviously been an interesting 12 months with the market shifting. I've been through this before. Obviously, as I mentioned, StubHub was started at a time that is similar to the time we're in now. And then I obviously saw it in 2008 and 9. This is, the so-called end of the cycle. And this happens, business cycles are natural, kind of normal things that happen every, call it usually 7 to 10 years. This one was like a 13-year bull run, but usually they're shorter than that. I think a lot of people haven't ever seen one of these. So people are surprised, like what's going on, what's happening, but this is sort of the normal course of how the economy works. Anyway, so that's Craft, and happy to, talk more about, anything.
Yeah, no, that's great. Thanks for giving us a rundown. So I know we have some of the awesome, you actually have partners with Michael Tam in the community and portfolio company. So really cool. I know you and I could probably go on for quite some time. So I definitely want to try to get to some of the questions from some of the founders that wanted to come on. If that sounds good to you, we'll jump into a group Q&A.
Sure.
Hey, let's see. Sean, hey, do you want to come on?
Hi, Jeff. Thanks for a great chat. I'm Sean, co-founder and CEO of Hopskip. We're a B2B SaaS-enabled marketplace that streamlines how planners book business events at hotels. We're about 3-year-old and done a little under 30 million in GMV to date. Our current business model is based on annual subscriptions to the platform, and right now, we're paid only on the demand side and freemium on the supply side. We just reached a current annualized revenue run rate of 470,000. Excuse me. And we've experimented with a take rate in the past, but we've recently removed it to further increase velocity of our flywheel. So my question is, how do you evaluate SaaS-enabled marketplaces that have recurring revenue, but are currently not charging a take rate?
Yeah. Thanks for that question, Sean, and great to meet you. So I would say a couple things, about the situation you're in, and I've seen this before. I think on the one hand, SaaS businesses have been, I think, and still are in some ways the the kind of darling of the venture community, right? Venture investors love SaaS businesses because they have recurring revenue. They're sort of very predictable. Typically, if you're seeing, I mean, the best SaaS businesses see expansion in their cohorts. So they usually, it's important in a SaaS business, I think, to have expansion built into your pricing. So you have to figure out a way for a cohort of customers to actually grow over time. Sometimes that's done through seat-based licensing, and you expect your customers to expand the number of seats they have, which would more than offset any churn you get. So as long as you get seat expansion that more than offsets churn, you're going to get expansion in your cohorts. Sometimes it's usage-based pricing instead of seat-based pricing, and you can sort of get more revenue from a cohort over time. So I think if you're going to be a SaaS business, I think figuring out expansion is really important in your pricing model. But as I was saying, SaaS businesses tend to be really favorable to venture investors. Having said that, my own experience is that marketplaces have a couple of key advantages over SaaS businesses. One is that you tend to have even more expansion potential in a marketplace because your revenue is a percentage of the kind of volume through the marketplace, and so as long as that volume grows, your revenue can grow, and you're not bound by, like, say, number of seats or amount of usage. Really, you're really just bound by revenue, and sometimes revenue can expand beyond, say, users or even usage. And so I feel like a lot of times there's more upside revenue potential in a marketplace model where you are taking a take rate. I think I think one of the, and I think the other question with, kind of the SaaS model, depending on how your pricing works, is like, how big can it get? Let's assume you get like everybody in the hotel business using it and everybody that's booking events at hotels using it. Like, what is that number? And you multiply it out, like, what is that market potential? Because in many industries or verticals, it just doesn't get big enough to be super interesting. Like, right, you want to be able to have a business that can get, I mean, if you're looking for like venture scale outcomes, and not everybody is, and that's okay. You can have a business that's kind of more of a lifestyle business, or that's a profitable, $5 million a year business that grows 20% a year or something. But to get to venture scale outcomes, to attract venture investors, generally you need to sort of see a path to 100 million of revenue. You need to be like tripling your revenue every year. And so you need to have this kind of like hyper growth. And so depending on how that math works out, it may or may not be big enough to kind of just stay as a SaaS only model. I think as an investor who's focused on marketplaces, I think in some ways your business isn't really a marketplace yet, because at least as the way I define marketplaces, it is a take rate. You are bringing together supply and demand, and you're extracting a take rate from the transactions that they do. That's kind of how I think about a marketplace. Otherwise, you're really a SaaS business. You're providing a SaaS tool to one side, and you can then build. The idea of a SaaS enabled marketplace is a really great playbook, which is you build a SaaS tool. Usually, you start off with a SaaS tool for one side. They start using your SaaS tool, and then you bring in the other side of the marketplace, and then you start to extract a take rate. Sometimes you give away the SaaS tool for free. Other times you charge for it. There's different models there, but eventually you're taking a take rate. I think in a world where you're not taking a take rate, especially in a world where you've already tried and have taken it away, as you described earlier, I think there's always a question of, are you going to be able to take a take rate, right? Like it sometimes isn't so easy to take a take rate, right? Depending on how much value you're providing to the demand and the supply. If it's enough value and you're able to kind of address things like disintermediation, if they can just go around your marketplace without you and they don't really need you, then it's going to be hard to take a take rate. Or if they can discover one another without your marketplace, it's going to be hard to take a take rate, or at least any material take rate beyond, say, like a payment processing kind of take rate, like a 3% or 2 to 4% take rate. If you want to get into like the 10 to 20% take rate area, you need to be driving incremental demand. Typically speaking, the supply side of these marketplaces, in most cases I've seen, are either businesses or individuals who are essentially, their income is kind of dependent on the marketplace, right? So it's individuals, it's people who are generating revenue or income for kind of like livelihood or business reasons. And so for them, they want more revenue. And in order to be able to extract a take rate of the 10+% type, you need to be bringing them more, like you need to be like showing them that you're bringing them more revenue than they would otherwise have without your marketplace. And then you can start to extract like a real take rate, because you're actually, that is the number one thing any marketplace can do, is drive demand, right? Other bells and whistles and features are great. It's like beautiful, user experience or whatever. I'm not saying that that's not important. It is, but it doesn't compare to actually driving demand for the supply side of the marketplace. And that's when you're driving incremental demand, that's when you can start to really take a bigger take rate. And I think until and unless you start doing that, I think an investor is going to wonder if you're going to be able to do that. And once you start doing it and proving that you're doing it, then you've proven you can do it, and then people can start to run the numbers on probably what I suspect would be kind of a bigger market potential than whatever your SaaS model is. So that's my quick take on that. I don't know if that answers your question. That doesn't mean that it's a bad business or I don't like it. It just means you kind of have to prove you can do it in order to prove to yourself and prove to anybody else that you're going to be successful doing that. I am wondering and curious why you took it away after having it.
Yeah, so the short answer is to remove friction for adoption, and to add a couple more details in there. So on the demand side are professional planners, on the supply side are hotels. About 45% of our planners, the demand side, they rely on earning commissions from hotels. So we would be eating into our demand side revenue, and hotels generally don't like to pay out multiple commissions to multiple parties. So our thought was, we've done, like I said, about 30 million in GMV. Half of our company's lifetime was during COVID. So we've seen a lot of growth, and we want to continue with that growth. And we know by continuing to have a take rate, at least during this phase of our company's journey, is just going to slow down growth. We have collected a commission in the past. We've earned about $75,000 in commission revenue over our company's lifetime, but again, removed it for those reasons I just mentioned.
I have mixed feelings about the idea of having a free marketplace to get users and then introducing pricing later on. On the one hand, I think it can work, right? You can get a lot, and I know yours isn't free. I know you have a SaaS model, but I'm just saying, like a zero take rate model, or even a completely free model where you just try to get a bunch of users and then you're gonna sort of monetize it later. In social media, that's the name of the game: Facebook, Twitter, others. You have a free product and you get to huge scale, and then you can start to introduce ads in those models. In a marketplace model, I have mixed feelings about it, because on the one hand, you definitely want liquidity, you want the flywheel spinning, you want the network effects of supply and demand, and maybe to the extent that helps you get there and kind of lock in ownership of a space, a vertical, whatever it is, and you're able to monetize it later, maybe that can work. On the other hand, like, one of the things I like about marketplaces, and when I invest in marketplaces personally, is I do like the fact that you can monetize these things very early on, right? And if you look at what we do at Craft, both SaaS and marketplaces, unlike other verticals, like robotics or artificial intelligence or businesses that require lots of R&D before you can start to monetize. The thing about SaaS and marketplace businesses, usually with like a couple $1 million and a small founding team of a few, 5 people, you can build a product, launch, and actually start to monetize, pretty quickly. And that's one of the things I like about, SaaS and marketplace businesses. They're highly capital efficient. You don't need to spend $20 million in R&D, before you launch a single thing, or, build a robot or something with, tens of millions of dollars before you can sell your first robot. So we do these businesses because they're capital efficient before, they can monetize quickly. So my own view is I would want to see, I think your SaaS model is interesting. It's great that you're monetizing. I don't know what that math works out to be and how big that can get, like I was describing earlier. If that can get big enough, then maybe you don't ever need to do a marketplace model. If not, then you kind of need to do the marketplace model to get to like significant scale. And then the question is, then I would sort of say, like, the sooner you can do that, the better.
Quite a few had a similar question in the community, and we couldn't go a question or go without asking about SaaS-enabled marketplaces with Craft. So appreciate that, Jeff. We're going to try to squeeze in one last question because I know we're actually short on time here. So hey, Laura, do you want to come on?
Yeah, thanks so much, Mike. Hey, Jeff. My name is Lara Vandenberg. I'm the founder of a SaaS-enabled marketplace, or by your definition, more of a SaaS company called Publicist. We exist to help brands and agencies source and manage all of their external marketing talent. So launched 2 years ago, launched very much as a double-sided labor marketplace. Learned quickly that enterprises want to use us as a bench of their existing talent and then to source and manage through workflow tools, all of their kind of net new talent. We, as of like last quarter, went from monetizing as a marketplace, and we're now just doing ARR. And so these are big 6-figure licenses. We've just onboarded Ernst & Young as our first enterprise customer. But my question is, next quarter, probably we'll go and raise, we've raised 2 million to date. We'll go and raise, call it a seed plus. How much does TCV matter in terms of, like, do investors care about total contract value? So the deals that I'm focused on signing right now are kind of like 3-year, 6-figure licenses. Is that a concept or term that even matters, or is it more around ACV and just kind of like booked revenue, is my question.
I think the total contract value matters, right? Which is just the number of years times the annual contract value. Because it shows, it shows lock-in with customers, depending on what the terms are. Sometimes it's not really total contract value if they have the right to terminate, right? If the customer could just like fire you after 6 months, it's the fact that you have a 3-year deal. It's not really a 3-year deal, it's a 6-month deal. So assuming they're really 3-year locked-in deals where the customer can't leave, then yeah, I think that matters. But it's really, I would say, not as much as like the annual number, because people think about revenue in sort of annual terms, like how much, what is your annualized revenue today? It's more of an annualized number, not really like a total contract value number. But I think it matters to have longer term deals. I think that's a good thing. So yeah, I think that's the short answer to the question. And and I think it sounds like it's like a tool for managing workflow with independent contractors and maybe creative independent contractors and employees of companies that are doing kind of creative type work, and and that that could be an interesting SaaS business, and depending on like how big that can get and a bunch of other things. But again, and as I said to who was it, Sean, who I spoke to last? Maybe I got the name wrong. SaaS, in many ways, SaaS businesses are they are the sort of darling of the venture community, and in many ways of Wall Street, right? The publicly traded SaaS companies have traded at huge premiums to the marketplace companies today still. So there's nothing wrong with the SaaS business at all. It could be great business.
Right, thanks.
That's a great question. So I know we're almost out of time here. So and we do have some more pure kind of marketplaces here in the community that had questions. So yeah, if you guys want to maybe share those on Twitter or something after, we can maybe try to get to those. But yeah, Jeff, this is a really great chat. So thanks for taking the time to join us here. I feel like we got kind of a master class on all of your experience with StubHub, learnings and kind of insights on that, and now more on SaaS-enabled marketplaces here on investing. So, thanks again for taking the time to join us here today. I actually had one last question for you though, and that's, if you were to go right back before you started StubHub, what would you tell yourself specifically about marketplaces?
Well, I would say, I would say a couple of things. Number one, I would say that marketplaces, given what I know today, I'm assuming I know what I know today, and that's what I'm using to tell myself, 22 years ago, 23 years ago, I guess. It would be, number one, I would say, marketplaces are a great area to focus on for a startup, because there's great network effects and dynamics and kind of moat that comes along with that. So you're on the right path. If younger Jeff, if you're thinking about starting a marketplace, keep that up. I would say that try to sort of like isolate the problem a little bit and figure out something narrow and smaller to solve first, and then kind of grow from there, from that kind of nucleus, which we did. So I guess I had some insight there, or somebody told me along the way to do that. I'm sure it was the latter. I don't think I figured that out myself. And I would also say, like, it's a great time in your life to start a company, generally speaking, because you're young and you're not yet married. You don't have a lot of other obligations in life, and so you're kind of a 24-year-old. I think I was at the time. And just go for it. So those are the things I'd say.
Yeah, there's just some great parting tips. So last but not least, time for a quick plug. Where can we keep up with you and all your awesome writings too?
I would say follow me on Twitter. My Twitter handle is at Jeff Fluhr. I actually don't tweet a ton, so you won't get a lot of garbage, but that you also won't get a lot of content. That's one way. I would say also follow Craft Ventures. But whenever I do write something, and I don't write a ton, but whenever I do, I'll tweet it. And sometimes I'll tweet things that I don't write full blog posts on. I think if you follow Craft Ventures and you follow my Twitter, those are probably the best two ways to kind of keep up with, kind of things that I'm thinking about and the craft is thinking about.
Awesome. Well, you'll have a lot of marketplace founders coming your way. So thanks again for the awesome group chat. This is really fun, Jeff. So we appreciate, taking the time to join us here. And we're all huge fans of StubHub too. So that was really cool to have you join us.
Thanks, Mike. And thanks everybody in the community for joining today. Had a fun time.